Okay, welcome everybody, and thank you for joining us today for this webinar brought to you by Scandinavian Capital Markets. Today we're going to be talking about price action trading strategies, and I'm your presenter, Dan Blystone, speaking to you from Barcelona today. And without further ado, let's jump right into it. So first of all, to tell you a little bit about myself, I'm a market analyst, former proprietary trader, spent many years in Chicago trading bond futures. I founded a website called Trader's Log, and most recently I've been working as a market analyst for Scandinavian Capital Markets up in Stockholm. My background is largely in technical analysis, futures options, and Forex. So I wanted to start out this presentation on price action trading with a couple of quotes. First of all, this one by Jesse Livermore, who is widely viewed as being possibly the greatest trader of all time. There's also a very famous book about him called Reminiscences of a Stock Operator, which is also seen as one of the best books about trading. So in this quote, he's saying, "There is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." So he's touching on this idea that history repeats itself, that patterns repeat themselves in the financial markets, and there's also sort of the underlying concept that what is causing this is human behavior and maybe more specifically human psychology. So if we can keep that thought in our head while we move on and go into talking about price action trading, there's one more quote that I wanted to bring up also. This one's actually from the Bible, from Ecclesiastes, and it's very similar. "What has been will be again. What has been done will be done again. There is nothing new under the sun." In this case, nothing new under the sun instead of nothing new in Wall Street. But so this was a favorite quote of a trader called W.D. Gann, who was a pioneer in technical analysis and deep into looking at market cycles and history repeating itself in the markets. And that's something that relates very much to what we're going to be talking about today in terms of trading price action. So let's move on and look at the next slide. So underlying this repetitive phenomenon, we have market psychology and human behavior. So human psychology and crowd psychology, the behavior that stems from it, doesn't change and never will. So the same patterns repeat themselves over and over again in the financial markets. And therein lies our opportunity. So when you understand the psychology of the market, trading opportunities reveal themselves, and that's what this study of price action trading is all about. So we're going to be looking at price patterns at key times in the market where there's a shift in balance, where there's a shift taking place between the bulls and the bears and who's in charge at that time. And when you're able to identify these points, you're able to capitalize on it potentially, and there can be some very good trading setups. So you're moving from looking at psychology to having actual concrete trade setups from it. We're going to go into how to learn about that. So if you go to the forums like Forex Factory and a lot of these other places, price action trading is something you hear frequently. There's a lot of gurus talking about it. It's popular, I think, because of its simplicity. It's popular because I think people get into using a lot of different indicators and they get stuck, and they like to come back to using just very few indicators. So, and it's also applicable across all markets and all time frames, basically. So what this method of trading uses is the raw price movement of a chart with the minimal use of complex technical indicators like oscillators or moving averages, so forth, any kind of derivative indicators. So yeah, ideally you would like to have a chart that is as sort of open and clear as that picture of the desert, and when a signal does come up, you're able to see it easily. Part of the problem of having a lot of different technical indicators is you get something called analysis paralysis. So at a basic level, when you're using price action trading, it prevents you from falling into that trap of being overwhelmed by too many technical indicators. So if you're using a chart like the one on the left, you might have, one thing telling you to buy, one thing telling you to sell, conflicting signals, and so much information that it becomes difficult to make any kind of trading decision on where to enter and exit the market. So price action traders use patterns. They usually use major support and resistance levels also to inform their trading decisions. So if you've been into trading or technical analysis for a while, you will have doubtless heard of Japanese candlesticks. And essentially, Japanese candlesticks is price action trading. The setups that you hear about in price action trading often equate to various Japanese candlestick patterns, and basically people use these in conjunction with major support and resistance levels, usually just horizontal, the simplest of support and resistance levels. So we'll digress quickly and have a quick discussion of support and resistance levels. Price action traders typically confine themselves to major horizontal support and resistance levels as opposed to trend lines and so forth. And they may use a major moving average, say the 200 period moving average. But again, the emphasis is to use as few indicators as possible. But in order to use support and resistance, it's important to understand a few basic concepts. So one thing it's important to know is that the number of times a support and resistance level has been tested helps you gauge the strength of that level. So let's take a look at a chart and take a look at how the level has been tested and how this helps us gauge that it's actually quite a strong level. So we're looking at the Bitcoin daily chart. We see that price came up and there was resistance. It hit this resistance level a couple of times, bounced off it, then went up and finally broke through it. And then what we saw was price came back down and resistance became support. On a couple of instances there, a couple of occasions, the prior resistance level became support. And so all of these things, the fact that it was twice the resistance level and twice the support level, tells us that it's a pretty important support level now. One other comment about horizontal support and resistance levels and trying to gauge their strength is that it's good to see the times that the support level was tested spaced out fairly well. So if all of those tests were within a small number of bars, it would be a less of a significant level. So having touched on support and resistance briefly, let's get into the real meat of the discussion of the presentation, which is to talk about the patterns themselves. My favorite pattern, and one that you hear about a lot online and from various educators, are Pinbars. So this Pinbars term was coined by a guy called Martin Pring, a technical analyst, and Pinbar is short for Pinocchio bars. So he called them Pinocchio bars because they lie about market direction initially. So they're basically a candle with a long wick. So the long wick of the Pinbar is like the long nose of Pinocchio when he lies. And these can be highly accurate reversal patterns, particularly when they occur at a support or resistance level. So what might happen is you have an uptrend, you have a pin bar that reaches up to a resistance level, and then price rejects that level and ends up closing lower than where it opened for that bar. So let's go in and take a look a bit closer at pin bars. So The most powerful pin bars appear at the top of an uptrend or at the bottom of a downtrend, and are candles with long wicks and short bodies. They're essentially the same as a shooting star at the top of an uptrend or a hammer at the bottom of a downtrend in Japanese candlestick analysis. So here we've got an example of a pin bar in the pound against Australian dollar 4-hour cross. So what we can see here is that we had a nice steady uptrend, and at the very top, price traded higher, but the bulls had to change their heart, and price came right back down and closed near the open. And then you can see on the succeeding bar, the area where it's circled, obviously, that price traded sharply lower after that. So this is the area where it's kind of a key inflection point, and the balance of power between the bulls and the bears changes. And what that pin bar is telling you is it tells you a lot about the psychology of the market. So price opened close to where the low is now, traded much higher, but came screeching back and closed near the open. So that tells you a lot about the psychology of the market in that bar, and that the bulls certainly lost a lot of confidence, and that there was a possibility that there may be a reversal coming up. So in the case of a bearish reversal pin bar, price probes higher during an uptrend, but then makes a sharp pullback to close near the open. This indicates a lack of confidence among the buyers, and that the sellers may subsequently take charge. Here's a nice one on the silver hourly chart. Again, we've got a really nice uptrend. At the very top of the uptrend, we got our pin bar. We can see that price traded much higher. We got a really long wick there. And in this instance, price actually closed below the open. So that's why we've got the small red body there. So that's actually qualifies as a shooting star Japanese candlestick pattern. Basically, the candlesticks have slightly more strict interpretation, but it's the same thing more or less. All the same principles are involved. And then you can see in the following bar that the bulls completely lost their footing, and bears took over, and again price traded sharply lower, and it was the beginning of a pretty substantial downward trend in price. So let's take a quick look at the inverse situation. So conversely, during a downtrend, pin bar occurs when price reaches down to a lower level but bounces to close near where it opened. And so in this case, we see the bears losing their grip, and that the bulls may overpower them in the next time frames. So here we're looking at another cross. We're looking at the pound against the New Zealand dollar in this case. And we can see there's a nice downtrend. And then in the area that's circled there, we can see that price made a new low, but it reversed sharply, came back to where it opened, and closed higher, which gave us the green body for that bar. And then price went on to reverse sharply and go up and be in a pretty steady uptrend for a good number of bars, like 20 bars or something. So again, that was a very good reversal pattern, and that bar, the pin bar itself, gave us the clue that maybe the sellers are exhausted and now the buyers are going to come back into the market. The fact that price closed below the open is an additional clue that the bulls are more in charge here than the bears. So pin bars have a pretty good accuracy rate in trending markets. They provide especially strong signals when they reach up to test a major resistance level in an uptrend or fall to a major support level in a downtrend. So those are really great signals when you have confluence of price reaching up to a resistance level and or falling to a support level will give you an even higher probability trade. So next, let's talk about how to actually trade these patterns, because it's not clear. It's quite intuitive to understand why the patterns suggest that trend might change at those levels, but how do you actually trade it? So here's the sort of traditional way of trading these patterns. And so when a pin bar forms at the top of an uptrend, the sell entry is typically initiated in the following bar. So you wait till the pin bar is formed and the following bar is opened. And in the case of a pin bar at the top of an uptrend, you place your sell stop order below the low of the pin bar. And then you place your protective buy stop order above the high of the pin bar. So if price goes all the way up and trades above the high of the pin bar, it's clear that the pattern has failed. To be more conservative, you could just place the stop halfway up the pin bar, so that would limit your losses a bit. So let's look at the chart and see how that works out. In the inverse situation, in the case of a pin bar appearing at the bottom of a downtrend, the buy entry would take place when price rises above the high of the pin bar itself, and the stop loss is placed just below the low of the pin bar. So in this instance, where we're looking at the pound against the Australian dollar on the 4-hour chart, I'm going to point with my pointer here. So we have, this is the pin bar here, right? And then you wait till the pin bar is formed. And then the traditional way of trading this, this setup is to enter with a sell stop below or at the low of the pin bar, and you place your protective buy stop above the high of the pin bar here, or if you're being conservative, just above halfway up. So when price trades lower, your sell stop will be initiated, and you'll be short as price trades lower. So if you're not clear on what a sell stop order is, just shoot me an email. I'll be happy to explain it to you. But basically, it allows you to get into the market below the market. So it's like you only get into the trade if price goes down there. Your stop will only be triggered if price trades down where you placed your sell stop order. So that's how you would get into that's how you get into the trade, with a bearish reversal pin bar setup. And now to talk about risk and profit targets. So an appropriate profit target would be greater than the amount of risk assumed. That's kind of the conventional wisdom, although I always encourage people to test things. A profit target of 2 to 3 times the amount of your stop loss would be reasonable. So for example, if your stop loss is 15 pips from your entry level, your profit target could be placed at 30 to 45 pips from your entry level. So this will tip the odds of your success, tip the odds of success in your favor, having a larger profit target than your stop loss. Another comment is that generally the longer the time frame, the more powerful the signal. But that comes with a caveat that the longer the time frame, the fewer signals you're going to get. So patterns that arise on a daily and 4-hour charts are great and among the most interesting, but you'll have a limited number of trades during the week. If you go down to a lower time frame, you're going to get more trades. So if you're just trading the daily and the 4-hour chart, you're not going to have to spend a lot of time in front of the screen. In fact, you could have a day job and quite easily keep an eye on any patterns that come up on the daily or 4-hour chart. But if you trade on the hourly time frame, you're going to get a lot more signals and a lot of interesting signals. I think it's a good time frame, but it requires a lot more time in front of the screen, of course. Okay, let's talk about our second price action pattern, and that's inside bars. Inside bar is a two candlestick price pattern that equates the harami in Japanese candlesticks. So this pattern is defined by a candle that is completely contained within the range of the previous candle, also called the mother bar. The inside bar should have a higher low and a lower high than the mother bar. So here we got the silver daily chart, and we've got an inside bar. In fact, we've got a series of inside bars. So this area here, so here is our inside bar. Here's the mother bar, and here's the inside bar, because it's contained completely within the prior bar. And in fact, we have now several inside bars, which makes it an even more interesting setup. So basically, the idea with the inside bar is you're looking for a potential breakout, either above or below the range that's set by the mother bar here. Now, since we're in a downtrend, the more attractive trade would be to trade a breakout to the downside, because you're already trading in the context of a downtrend. So that would be a continuation pattern. But if price traded out, broke out to the upside too, that'd be a reversal pattern, also tradable. So people trade inside bars both as reversal patterns and as continuation patterns. So again, this pattern indicates that the market is consolidating and reflects indecision and uncertainty. Inside bars can be traded both as continuation patterns and reversal patterns. When an inside bar occurs in the context of an uptrend, you enter long when price breaks out above the high of the first bar, the mother bar. The stop loss is typically placed below the low of the mother bar. The profit target should be greater than the risk assumed at, say, 2 to 3 times the distance of your stop loss. And conversely, when an inverse bar forms in the context of a downtrend, the sell entry takes place when price falls below the low of the mother bar. The stop loss can be placed above the high of the mother bar with a profit target at 2 to 3 times the distance of your stop loss. So again, just to clarify, here is our mother bar, here is our inside bar, series of inside bars. Our bias should be more towards a breakout to the downside, because we are trading in the context of a downtrend on the daily chart, but you could trade either side of it. You could trade a breakout to the upside here also. Inside bars are typically best traded on longer term time frames, such as the 4-hour and daily charts. People get a sense of this because they occur so frequently on lower time frames, and you get the consensus is that you get a lot of false signals on lower time frames. And thirdly, our third price action pattern or setup is to look at falling momentum. So another important aspect of price action trading is to understand what the size of a candle body tells us about the momentum in the market. A series of long-bodied green candles reflect the buyers are in control, while consecutive long-bodied bearish red candles indicate that the bears are in charge. So these are called maribozus in Japanese candlestick lingo. So we're actually going to look at the opposite of this, though. We're not looking at the long-bodied candles. We're looking for candles where there's a long-bodied candle, but they get progressively smaller, suggesting to us that momentum is waning, fading out. So when the body of candles gets progressively smaller when approaching an important support or resistance level, this shows a loss of momentum and indicates a possible reversal at the support or resistance level. So here we got the Aussie dollar, Australian dollar against the US dollar on the daily chart, and we can see that we got strong momentum here at the beginning in this downtrend we have here, but we see the momentum dying out slowly as it falls, as price falls to a major support level represented by the 200 period simple moving average. And what we see here is that momentum decline came right down to the 200 period simple moving average and bounced just about there. And we can really see that the market is respecting this 200 period simple moving average because it's tested it here again twice also. So that's an instance of looking at declining momentum when going into a support level and having a potential bounce at that support level, based on the knowledge that you know that the market momentum is waning and that price could reverse. So when price is in a downtrend and the bodies of candles are getting progressively smaller when you're approaching a support level, this suggests that price is more likely to bounce at that level. You can trade this by placing your buy order at or just above the support level, and your stop loss can be placed below the support level. So again, we have the chart here. So in terms of trading this pattern, you could have placed your buy order just above the 200 period simple moving average and placed your stop loss just below it. So in this instance, you could have put your profit target to be larger in relation to the stop loss, placing it 3 to 5 times the amount of the stop loss, because there was certainly a lot of room for price to run there, and you might have wanted to keep the stop loss relatively close under the 200 period simple moving average there to limit your risk. So to wrap it up, guys, the value of price action trading lies in understanding what these patterns tell us about the psychology of the market at these key levels where the balance of power is shifting between the bulls and the bears, between the buyers and the sellers. And with that, I want to thank you very much for joining our presentation today. If you have any questions, please do let me know. You can reach me at dan@traderslog.com. And I hope to see you in the next presentation. Have a great week.